Welcome to The Explainer. Today, we're taking a deep, highly analytical dive right into the absolute core of our global financial infrastructure. Now, if you work in banking, or honestly, even if you just follow macroeconomic trends, you hear about this system all the time. But today, we're going to break down exactly how cross-border payments actually function on a structural level.
And we're going to start by shattering probably the most common illusion in international finance. SWIFT does not actually move money. It doesn't hold a single cent, and it certainly doesn't clear funds. It moves messages. That's it. It is a highly secure, standardized communications network.
So here is our roadmap for today. 1. The messaging illusion. 2. The mechanics of money. 3. The ISO 2022 shift. 4. The competitive landscape. And finally, 5. The future of global finance. Let's get right into it.
Section 1. The messaging illusion. Data over dollars. To really understand SWIFT, which stands for the Society for Worldwide Interbank Financial Telecommunication, you have to look at it for what it truly is: a cooperative message carrier. Think of it as an exclusive internet just for financial services. It routes over 40 million highly secure, standardized data instructions every single day. The critical function here is the secure exchange of proprietary data. It ensures reliability, confidentiality, and integrity. So when a bank in New York wants to send funds to a bank in Tokyo, they use SWIFT to securely transmit the instructions telling that receiving bank exactly what to do. It's essentially a highly militarized version of a WhatsApp message. The money itself? Well, that moves on a completely different track.
Section 2. The mechanics of money. How funds actually settle.
So if SWIFT is just passing notes between banks, how does the capital actually cross borders? The answer lies in correspondent banking, which operates on what we call nostro and vostro accounts. Because SWIFT doesn't hold the funds, actual settlement relies on this legacy system of reciprocal bank accounts. Nostro simply means ours, and vostro means yours. For example, a bank in the US holds an account funded in yen at a partner bank in Japan, and vice versa. When that SWIFT message arrives with payment instructions, the actual funds are simply credited and debited across these pre-funded bilateral accounts. But there's a major drawback here, and that's liquidity cost. To make this whole system work, banks literally have to tie up billions of dollars in pre-funded accounts all over the globe, essentially trapping capital just to ensure they can immediately settle transactions when a SWIFT message eventually comes through.
Let's look at how the messaging and the money actually sync up in practice. Many large value payment systems use a V-shaped or Y-copy routing structure. In Step 1, Bank A initiates the transfer by sending a message into the SWIFT network. Step 2, SWIFT intercepts that message, copies it, and sends that exact copy to the central settlement institution. In Step 3, that settlement institution clears the actual funds and sends an approval back to SWIFT. And finally, in Step 4, SWIFT forwards the original payment message to Bank B. As you can see, the messaging and the money movement operate in tandem, but they are distinctly separate layers.
Section 3. The ISO 2022 shift. Upgrading the language of finance.
Now that we understand the plumbing, we need to discuss a structural upgrade that is currently reshaping this entire ecosystem. Historically, banks communicated using MT, or message type, formats. You've probably heard of the MT-103 for customer credit transfers or the MT-202 for bank-to-bank transfers. Well, those formats were strictly limited. By November 2025, the industry is mandated to shift to ISO 2022 XML-based equivalents. And this brilliantly illustrates the change. Notice the exact translation where the legacy MT-103 customer credit becomes the PAX 008 and the MT-202 becomes the PAX 009.
So why does this alphabet soup actually matter to you as a banking professional? Well, these old MT formats were originally designed for telex machines back in the 1970s, meaning your highly complex cross-border payment was literally speaking the same language as a rotary phone. ISO 2022 fundamentally changes the quality of that data. It uses a richer XML-based structure. Instead of vague originator and beneficiary fields that can easily get truncated or cut off, you now have distinct, structured tags for debtor and creditor. You have dedicated fields for structured addresses. This eliminates a ton of ambiguity. It dramatically improves straight-through processing, meaning transactions complete automatically from end to end without human intervention, and it fundamentally reduces operational friction.
But perhaps more importantly, this richer data dictionary is heavily tied to compliance.
With the sheer complexities of cross-border transfers and strict regulations like the EU's transfer of funds regulation, supervisory authorities expect institutions to screen every single node in a payment chain. Better data means tighter compliance. Regulators require you to cover all identified parties, screen every intermediary financial institution, and accurately parse out unstructured narrative fields for hidden geopolitical risks. When the data is structured correctly in ISO 20002, automated sanction scanners can do their jobs far more effectively. This is absolutely crucial because, under the old unstructured formats, banks were generating a staggering number of false positives in their AML screening. And that was costing the industry billions of dollars annually in unnecessary compliance overhead and manual review hours.
Section 4. The competitive landscape. Alternatives and challengers.
Because of SWIFT's ties to Western financial infrastructure and sanctions, a multipolar array of alternative rails is actively being built. This includes everything from state-backed systems to domestic instant payment networks and even private stablecoin rails. I want to anchor our discussion with this specific number, $25.53 trillion US. That is the approximate equivalent value settled by China's cross-border interbank payment system, or CIPS, in 2025. This isn't just a theoretical concept. The sheer scale of emerging alternative rails is substantial, and it's growing steadily.
However, context is key here. Notice the current delta in network participants. SWIFT maintains absolute dominance with over 11,000 participating institutions across more than 200 countries. CIPS has grown rapidly, sure, to 1,766 participants globally. Meanwhile, Russia's SPFS sits at over 550 users. So while the challengers are moving trillions in value, their network footprint is still just a fraction of SWIFT's legacy web.
Let's look at the architectural differences, starting with CIPS. As we established earlier, SWIFT is a pure messaging network. It requires those separate correspondent bank accounts to actually move the money. CIPS is structurally different. While domestic instant payment systems like Brazil's PIX or India's UPI brilliantly replace localized settlement, they still rely on SWIFT for the international legs of a transaction. CIPS, however, is a unified bridge. It combines both the messaging layer and the direct clearing and settlement layer for the renminbi. By doing both in one unified system, it completely removes the need for US dollar intermediary banks when settling RMB-denominated trade. This actively accelerates the currency's internationalization.
Then we have SPFS, which is the financial messaging system of the Bank of Russia. Driven largely by geopolitical sanctions, this was developed as a state-backed alternative to ensure domestic and regional stability. It provides redundant 24/7 financial messaging, utilizing both SWIFT formats and its own proprietary formats to bypass restricted Western networks entirely. This architecture also lays the groundwork for proposed initiatives like BRICS Pay, which is aiming to interlink these disparate regional systems to create a cohesive, non-Western settlement loop.
And looking slightly further over the technological horizon, we have Project mBridge. Backed by the Bank for International Settlements, this reached the minimum viable product stage in mid-2024. Unlike SWIFT or CIPS, mBridge actually uses distributed ledger technology, blockchain, to act as a multi-central bank digital currency platform. This is a structural bypass of the traditional correspondent banking system we talked about. It allows central and commercial banks to execute real-time, peer-to-peer, cross-border settlement instantly. Similarly, private stablecoin rails are attempting to replicate this exact instantaneous, DLT-based settlement on public blockchains. They act as parallel competitors to both traditional correspondent banking and state-backed CBDCs. Ultimately, they all aim to solve the exact same problem: bypassing the slow, fragmented liquidity of those legacy correspondent accounts.
Section 5. The future of global finance. Monopoly versus fragmentation.
So we have the dominant incumbent upgrading its data language and a host of well-funded state-backed challengers altering the underlying architecture. Are we looking at a monopoly or total fragmentation? This quote really captures the macro trend we're observing. We are moving away from a single, unified financial backbone. The geopolitical reality is that sanctions and financial restrictions have inherently pushed countries to explore alternatives to hedge against systemic dependence on Western infrastructure. But replacing SWIFT outright, that is incredibly difficult. Why? Because SWIFT has a massive protective moat. It's not just about the technology, it's the network effect of 11,000 interconnected institutions across 200 countries. It's the deeply embedded data transparency required by global regulators, and quite frankly, an unrivaled compliance architecture. Replicating this isn't just a technology problem, it's a legal and operational mountain. Banks have spent decades and billions of dollars integrating SWIFT into their back-office software. The sheer cost of ripping out those legacy systems, coupled with the legal liability of adopting unproven compliance rails, creates immense institutional inertia. Because of this moat, the future isn't about the sudden death of SWIFT. Rather, we are looking at a future of parallel, fragmented systems where institutions are going to have to route transactions across different rails depending on the jurisdiction, the currency, and the current geopolitical climate.
Which leaves us with a critical question to consider as professionals navigating this space. As we transition from a unipolar financial system to a network of parallel rails like CIPS and mBridge, does a fragmented financial landscape offer necessary sovereign resilience? Or does it merely multiply systematic risk, operational friction, and compliance complexity for everyone involved? It's definitely something to think about as you monitor the shift in our global financial plumbing. Thank you for joining me on this explainer, and I'll see you in the next one.